Peter Sorrentino, Senior Portfolio Manager at Huntington Asset Advisors from Cincinnati, where he oversees $14.5 billion. Many thanks for joining us, Peter, today. This Greece story, many discussing Greece should default, preserve its democracy. Portugal should also default, maybe. What do you believe is the best action, the best course of action to really give the markets peace of mind?
Well, they really have to, to free the banking system, not just in Europe, but also really in the U.S. as well. We're all sort of tied together into this sort of ongoing, Greek tragedy. There is a fear that of the unknown for all the financial sector, in that, we don't know what the ultimate course of action here is going to be. We keep getting these actions where they're kicking the can down the road, approving loan packages, when it looks pretty obvious now that Greece simply can't pay off that level of debt. And the same thing really affects the Irish and probably the Portuguese as well. And the societies are beginning to, fall apart under the strain. We're hearing stories of diaspora, again, people emigrating away, of, civil unrest in the streets of not only Athens, but Thessaloniki and a number of other cities. There's only so much you can ask these people in a short period of time. So our belief is you follow the example of Iceland. You simply have to admit these debts cannot be paid in full. Let's reset the clock and start. They don't have the option of abandoning the euro. We think they have to stay part of that. And so it's the debt that has to give.
So what really can they do? I mean, you mentioned a full restructuring of their outstanding debt, but what would you be advising right now Angela Merkel, for example, to do with Greece and Portugal and also Ireland?
I think there really has to be one of these moments where they just come clean. The sovereign debt issue is haunting the entire banking sector. They just keep adding to it by issuing more and more paper. What they need to do is essentially, stop, admit that the paper that's being carried is not, worth face value. This talk of additional austerity for the Greeks. It's simply something that I don't think in the short run you can ask them of that. Capital is fleeing, talent is fleeing, and so you simply can't austerity your way to prosperity. It's just not going to work this way. So, at some point there has to be a complete reset. Now, again, that's for the Greeks to decide how they do that, but the budget, simply as it exists now, cannot go forward. So I don't know if I'm quite with Denmark in that you put a troika on staff there 24/7, but clearly that's to get the Greeks help from the rest of Europe. It may be something like that.
But I must ask, you oversee $14.5 billion. You've been in investment since '81, so you're very hugely experienced. I mean, how many of your investors are nervous right now on a percent level? And also, how are you allocating your assets? Are you putting it completely in defensive plays or not? Taking some risk on?
We're actually trying to take some risk on here. We believe that investors have suffered effectively a lost decade. Last year, the market, for all its volatility, really didn't, in the U.S., did not go anywhere. There are areas in the world where we think there are opportunities. If you're going to, buy into debt issues, go to places where credit is improving, not deteriorating. So that takes us away from the U.S. and Europe. It takes us to the emerging markets. You move into places like India, Malaysia, Indonesia, Turkey. They're areas where capital is being rewarded. The emerging market equities are also very attractive in here. Interestingly enough, Europe and the U.S. are engaged again in what effectively is another quantitative easing. And where this devastated the emerging markets the last time out, it looks as though they have enough strength now to power their way through this. The commodity inflation that paralyzed them the last time out may only manifest itself in energy this time out, thanks to somewhat softer demand from the developed countries. So those markets, we think, offer some very attractive opportunities. And we've been advising investors to perhaps, if they're going to take on risk, look at those markets for that risk.
That's the risk play. Interesting and a very brave call is to say that gold, your forecast, will hit $2,000 an ounce by April. Clearly a safe haven play. But what's behind that fairly bullish forecast for gold?
Well, gold had a very substantial run early last year and has gone through a corrective phase. Some of this we think was attributable to the MF Global debacle. We think that frightened some commodity traders and some investors in commodities, and that some institutional money headed for the sidelines after that. But when we look at the amount of U.S. Treasury debt held by our major export partners, we're beginning to see significant systematic reductions in their Treasury holdings. They're, I think, uncomfortable with holding that much of their reserves in dollar-denominated assets. We're continuing to see central bank buying of gold by China. Russia has effectively nationalized all production. All the mines have to sell to the central bank. Venezuela nationalized their mining industry. We're seeing gold being bought again in India, as well as Vietnam and other countries. So there's a continual growing of demand. What's interesting for us is that's also an indication that we're approaching a top. Unfortunately, central bankers tend to be very bad timers. As we saw with when Europe was moving toward monetary union, they were selling at the bottom before the rally started, and we think that now we're seeing a significant amount of buying. It's probably an indication that we're approaching the top. So we think that, coupled with what we're calling quantitative easing 2.75 here in the States, probably pushes gold in dollar terms past that 2,000 mark early this year.
And overall, Peter, I have a last question for you again. You mentioned QE 2.75. It's almost exactly right. That pumping of money in the system, is that what's really keeping these markets afloat right now? If it wasn't for the ECB pumping money or the Fed pumping money, you would see a situation that's pretty bleak in the markets.
It is, and unfortunately, that's our view, is that we're getting to the law of diminishing returns. They've been hitting the liquidity afterburner for 3 years here, and it's just not achieving, any type of meaningful acceleration. It's simply the Keynesians versus the Austrians, and I think the Austrians may have had it right. The Keynesian approach just doesn't seem to be getting the results. That said, this is an election year in the States, and we'll probably see some pretty extravagant spending on the part of the governmental agencies to try to keep the party going for at least one more year. And so we think that effectively keeps the financial markets intact, at least over the balance of 2012.
Thank you for your time there, Peter Sorrentino, the senior portfolio manager and very experienced ES2 at Huntington Asset Advisors.